presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak Asset Management YouTube update for March the 28th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap. Thank you for joining me today. Let's start. I'm going to talk a little bit about the Fed. What are they doing? What are they saying? What are they expected to do? The market, what has it been doing over the last 3 weeks? We've seen a tremendous amount of volatility. The economy, where we are, and the technical analysis, and a little bit of the week ahead. So let's start with the Fed. This is the market expects the Fed to cut interest rates in the second half of this year. That's what the market is saying, that we'll stay at 5%. That's where we are right now. Then they'll cut in July 25 basis points to 4.75, and then continue to cut, bring us down to about 4% by the end of this year. I still don't think that happens. I know the market is expecting that. I think the Fed goes to 5% where we are now. There's a 50-50 chance that they're going to raise interest rates by another 25 basis points in May, and then pause and hold rates there until they see the economy slowing. And I don't mean unemployment going up, because unemployment is usually the last thing that goes up. When the recession's already here, everybody's running scared, companies are laying off people. That's usually the end of the recession, not the beginning. Unemployment is one of the lagging indicators, not the leading indicators. So I think we are going to see the Fed stay where they are. If they continue to raise rates, then they follow their own procedure. They continue to do it until they break something. And once it breaks, then they go, oh, we're sorry, and then they start lowering rates. That's what the market is saying the Fed will do. I hope they don't do that. We don't know if they will do that. We don't know even if the economy is slowing. We saw this banking crisis, and I said that 3 weeks ago right here, that I thought this was an isolated incident. Markets had got overbought. They needed a fundamental reason to pull back, which they did. You got everybody running and scared. Everybody that had bought the highs in February got blown out of the markets. Those are the short-term traders. They never make any money. They make 10 trades, they make some money, and then they lose it all in one trade, and then they're sitting there hoping one day to break even. They become hold and hopers, as I call them, where they're holding and hoping one day they'll break even. So that's the market expectation right now, that the Fed is going to cut rates. I don't think they do that. We'll have to wait and see what happens. Now, the defensive sectors have outperformed during the bank crisis. That means we've seen defensive and growth sectors have done well because interest rates plummeted over the last 3 weeks, but now they're starting to come back up. And as this panic ebbs, as we sit, the peak of the panic, I think, has passed already. We're past that, and I think as things settle down and they realize that not every bank is going out of business, everybody forgets about it. As I said 3 weeks ago, a month from now, we'll forget about SVB. I think SVB is just an isolated incident on some very bad bank management. So we are seeing defensive and growth sectors. That's where people move to. Defensive sectors to be safe during the banking crisis, and growth because interest rates dropped dramatically. But I think we're going to see that rotation back out. That's just a temporary thing where people are running. Bond volatility, bonds usually are, the boring stuff. They don't go up and down a lot. The blue line shows you the move in the bond volatility. You can see that bond volatility is shot straight up. Has come back down a little, but you can see the VIX, which is for the S&P, you can see that it's nowhere close to the highs. The bonds are more volatile than the stock market. Who would have thought that ever? I mean, bonds are the boring thing that you clip coupons and get your money. But with interest rates moving at the rate that the Fed has raised rates, that is the problem. Where a lot of banks are holding a hold till maturity HTM bonds. These are good bonds, but they're down 20%. If they have to sell them now, they have to take a 20% hit. They're holding them on the books as 100% value, but they're really 20% lower. If we discount these bank balance sheets by 20-30%, a lot of them could be in trouble. That's what the whole country is worried about, and that's what people are worried about. The economy, regional bank sector outperforms the S&P. Here's the As you can see, this is the S&P financials right here, middle line. This is the banking index, you can see that, and here's the S&P index. So you can see that it is underperforming the banking. Everybody's just getting out of banks. That's what they're doing. They're selling the banks, they're running out of banks, and they're going to the bigger S&P stocks. That's where they are. Different measures of inflation, flexible price inflation. This is stuff that goes up and down much faster. You can see a hit up here, and now it's really dropped dramatically. You can see the same thing. You can see sticky super core inflation and sticky price inflation. It has gone up, but it's not rolled over yet because it takes a while for the shelter and things like rents, because when you sign a lease, it's usually for a year. Once the lease is done, then people say, okay, let me see if I can get some discount on my rent or not. And that's where we see, so it takes a while for some of these to move. Don't forget to join me at the daily edition of Market Wrap every day on the radio, or you can just go to the App Store and type in Market Wrap with Mo Ansari. Just one word, this whole word right here, market, and you will download the free app. Then every day you'll get my daily edition of Market Wrap, and you can listen to it whenever you want at your convenience. Looking at the technicals, this is interest rates. We hit this. This is the 200-day moving average right here. You can see rates hit a high in October, and that's when the market hit a low. Rates came down, market went up, hit this 200-day moving average right here at the beginning of February. Took off, rates went up, market came back down. Now the rates have plummeted, and they hit this 3.29, even got below this number. I think they got overdone a little right here last week when the panic, oh my God, Deutsche Bank is going or whatever. And now the rates have come back up above the 200-day moving average. 50 days right here, 3.665. I think we're going to bounce around somewhere between 4. We are 3.564 today. And as long as we don't get any more bad news, I think we'll vacillate between this 4.10 and 3.5%. Go back and forth. That's what I expect rates to do. So not until we get some clear indication of what the Fed is going to do. Looking at the weekly S&P chart, let's go to daily S&P. This is an interesting chart. I've talked about this on the radio quite a bit, and I told all of you that I'm going to show you this chart on this YouTube update. So now you can see it. This is the downtrend line that I've been talking about, the high that we made in February, the high that we made right here this month so far. We connect this line, this blue line right here, and you can see that the market is right here. This is the 50-day moving average, which is 40.13. If we can get above this blue line and break out above this, we take off, then I think towards 4,200, or at least 41.95. This is the high that we made. This is, you can see, this is the support line on the other hand. This is the triangle. We're getting closer and closer to the apex. Either we break out or we break down. I think we are breaking out, but if we get below 3,800, this low, break this trend line, then the market is in serious trouble. Then I think we're headed towards first a little bit of support right here at 3,700 plus or minus, and then we're really looking at this 3,500. That's what if we break 3,800 on the downside. On the other hand, we can break out on the upside above this downtrend line, headed towards 4,200. If we can fill this gap between 4,200 and 4,218, this was what we left from last August, then 43.25 becomes the target. But we'll see. We have to break out right here. So I'm watching this chart very, very closely, 40.13. Weekly chart, nothing there. This is the long-term 42.02.04. If you get above that, that's very bullish, and then we're in a long-term uptrend. Nasdaq, again, above this red line is 20-day, blue line is 50-day, this magenta line is 200-day. We're above all of those, but we need to break out. We need to break out above this line right here and get going. If we can break out here, then we could head towards the 12.6, and this is wave 1, 2, 3, 4, and then we go towards wave 5. But we need to get above 12.2 first. If we can get above that, then I think we're headed towards the 12.6 to 12.7. Nasdaq weekly dots are below the market. This is the market, the vertical red and green lines. This is the dot plot. As long as the dots are below the market, that's a good sign. The dot is somewhere in 10.8. We closed at 11.7, so 1,000 points. If we can get above 11.2. In the Nasdaq, I think we're headed higher. Gold hit this fifth wave top. 1, 2, 3, 4, 5. We hit it. That's the fifth wave. Now we're starting to pull back. I don't know if we get some more on the upside on gold, but if we break below 1900, 1896, that's the 20-day and 50-day, then we are headed back towards here, which is like 1780 in gold. So I think gold is pretty much done, unless the Fed says they're not raising interest rates anymore. And if they say that, that could give gold some impetus, but we'll have to wait and see. Those are my thoughts. The upcoming seminar, I will be in Scottsdale. I will do a seminar next week. Come and join me in the evening on the 4th. If you'd like to meet with me, I will be there on the 5th. Then on the 16th, I will do a live webinar online. That's May 16th, so that's about a month and a half away. Anytime you want to meet with me, you can always go to compak.com, set up an appointment, and I will be more than happy to meet with you personally, or we can do it on Zoom. Those are my thoughts looking at the week ahead. Not a lot going on. We did get Case-Shiller housing shows is continued slowing. Not a lot of data coming out. So we'll just see how things go over the next week or so. Those are my thoughts. Those are my observations for March the 28th, 2023. I'm Mo Ansari. I'll see you next week.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.